Welcome back. You're watching Money, Money, Money. Fixed income looks to be coming of age in 2015. So how do you ride this wave? That's the question we've been asking Gajendra Kothari of Erica Wealth Management, and also with us today are two of our viewers, Trisha and Aseem Mehta. So we've spoken a lot about, in theory, how debt instruments could actually work for the retail investor. But in practice, there are so many categories of debt instruments. How does one know which category to choose from? And B, what kind of returns can one actually expect? I mean, if an FD is giving you, say, 8% now, maybe a little lower once the rate cut comes in, how high can returns from debt instruments go?
Okay. So coming to the first question, that what kind of debt funds people can invest in, and there are a lot of variety in them, So just to start with the low risk, low return, the first comes is the liquid fund, wherein any money, if you have less than 6 months, you can ideally park there and expect around 8.5% return there with low risk. If you have longer duration, 6 months to 1 year, then you can go one notch higher and you can put something in ultra short term bond funds, so which are of little higher duration than the liquid and can give you 0.5% extra. If you have a horizon of 1 year to 1.5 years, then you have short-term bond funds, right? And then if you have a horizon of 1.5 to 2 or 3 years, then you have something like dynamic bond funds and the long-term income funds. Now, these two categories invest most of the money in the long-term, debt instruments. So when there is a high rate cut, these are poised to give the maximum return. But these are also the most risky also, because if there is no rate cut, if the rate goes up, then you may see maybe negative return in the shorter time frame. So this is one thing you should keep in mind. Depending on what time horizon you have, you can choose one of those debt instruments.
Gajendra, I have a small child and all my relatives are advising me to invest in his name, either in bank FDs or gold or such other relatively safe instruments. So how do you think a debt fund would prove more beneficial to me as compared to all these other instruments which are kind of relatively safe?
I want to just add a point to what Trisha is saying. Should these investments, if advised to be in debt funds, also be in the name of the child? Or to claim taxation benefits, should parents continue to keep them in their names?
So at this stage, if you're doing an investment in the name of minor children, the income anyway is added to the parents' final income. So you won't get any tax benefit as such at the moment. But having said that, as you rightly said, most parents' mentality is to put in something like a fixed deposit for long term, so that when he or she goes for higher education or gets married, this money can be utilized. In my opinion, this may not be a very good idea. The reason being, a debt investment or a fixed deposit will always give you a fixed rate of return, which is close to 7, 8, 9%. At times, this may not be even good to beat the inflation, the basic inflation I'm talking about. So in the long term, you may not be able to see a real rate of return as far as the investment is concerned. If you have a longer term horizon for like this, we would always recommend to go for equity, because you have 10, 15 years. That is when you can expect 12 to 15% return, which can beat the inflation and you can see positive rates. Only for the shorter term duration, like 1 year, 2 year requirement, a fixed deposit may be a good idea.
How would you place corporate FDs vis-a-vis the debt mutual funds which are available right now? And if again corporate FDs versus the bank FDs. Also, if an investor has made up his mind to enter into the corporate FD scenario, what are the points which one has to look into, the fine print, which what they say, before they actually commit themselves to the corporate FDs?
I think it's a brilliant question, because corporate FDs is a segment which is not very much popular in India as of now, because most people go to banks and they lock in their investments there. Corporate FDs normally give a little higher return compared to the bank fixed deposits. Now, the more sound the corporate is, the less will be the return, So there are these ratings given to the corporate FDs. So if it's a AAA, which means it's the best rating, they will fetch you a little higher than the bank fixed deposit. If it is a AA, which means it's a little lower rating, then it will fetch a little more high return. And if it is a single A paper or BB, then it can give you maximum returns, Now you should not fall into this trap, because there are FDs which can give you 18% return. But you have to ask yourself, if this company is giving me 18% vis-a-vis a bank is giving me 9%, what are the risks out here, so that is where you need to study, you need to consult your financial advisor and then decide accordingly. So these bonds basically are called junk bonds of fixed deposits. We normally recommend people to stay away from these because there have been a lot of defaults in the recent past. Stick to good names, which are AAA names, and have a healthy balance sheets.
Since we're comparing instruments, how do small saving instruments compare with debt?
Okay, so small savings, there are a lot of investment options available in small savings. So the first being the PPF. Now PPF happens to be one of the best form of fixed income investment, primarily because you have 1,50,000 tax benefit under Section 80, and as of now PPF is at maturity, it's tax free. So all the interest is tax free, whatever amount you get maturity is tax free. So today PPF is giving around 8.7%, which is the best form of return as far as any kind of debt instrument is concerned. So if you want a safe return, then PPF you can go for. Other instruments like government recently introduced something called KVP, Kisan Vikas Patra, and government also has NSC. Now these are currently giving in the range of 8.7 to 8.9. As of now, it's not that attractive to bank fixed deposits because bank fixed deposits are even giving better return than this, and you're not getting any kind of tax advantage.
How would debt mutual funds actually help us in augmenting or help us in any way with regards to the management of the money for businesses? Actually, do we have any kind of leeway where we could park our funds and debt instruments, and it could be beneficial for us either in tax format or in the cash management part?
I would like to thank you for answering this, for asking this question, because this is $1 million question which a lot of businessmen asks us. How can we utilize debt funds in our business as well? The best would be the liquid funds to start with, because all businesses have a current account, and as you know, we don't get any returns in the current account. It's 0%. So you may have to make this payment to your vendors maybe 10 days later, or you have to pay a salary to all your employees which is 10 days away. So what to do with this money lying right now here? So the best way is liquid fund, wherein you just open an account in the name of the firm. You can open liquid fund in any bank, in any mutual fund, and as long as your money is parked, you're getting 8 to 9% return on that money, which is a huge amount. So most Indian corporates, be it small, medium enterprises, just park the idle money there. If you have a horizon anything above 6 months, then you can go for something like ultra short term or short term funds, which I talked about, which give you a little high return. But I think debt funds are the best way for the corporates, SMEs, or even a small proprietorship firm to take the advantage of higher interest rates which they offer.
Thanks very much, Aseem and Trisha, for joining in. I hope this has been beneficial for you. And I want to ask you, are you going to go out and invest in debt funds now?
Absolutely.
Yeah, most certainly.
Okay, I know. I hope you're not just saying that because I'm asking you.
No. I mean, rather than keeping it lazy, I would rather make it work for me. So
all right, touche to that. Thank you very much, and a very happy new year to you as well. Gajendra, you have to stay on. There's more on this show. So we'll take a very quick break. Before that, here's our weekly question: are you convinced enough to invest in debt instruments? Write to us at money@network18online.com and stand a chance to be a part of one of our future episodes. Do stay tuned. Still ahead is our viewer call-in segment. Can I afford it?